Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's had a very long and successful career on Wall Street. He's run hedge funds. He's been the chief investment officer at a number of funds. He's also had mutual funds where his name was actually on the mutual fund. Very, very impressive. He wrote the book Confessions of a Wall Street Whiz Kid. He rose up the ranks on Wall Street with very limited education. He is unbelievably smart. He's extremely well read, and he pulled himself up by his own bootstraps. Peter Grandich, thank you for joining me again.
Well, Jason, very kind to you. Some of that was in my days of when I was a legend in my own mind. Thankfully, those days are gone, but I do appreciate the kind words.
Well, you've accomplished a lot in your career. I mean, like most of the Wall Street people, Peter, are handed things. So a lot of people, they go to the Ivy League schools, they go to the top business schools. You didn't get to do any of that. You had to put in all the work all by yourself. So it's just incredible what you accomplished in your career. And you didn't go to Harvard undergrad or Harvard Business School or Wharton or anything like that.
I went to the best school, the School of Street Smarts.
Yeah, unfortunately, I wish more people in business running the government here in Washington D.C. area and on Wall Street actually went to the same school as you, because I think unfortunately we have too many academics here pulling levers with bad policy after bad policy. And for our listeners out there, we're recording this interview on Monday, April 14th, 2025. The US dollar gold price, it's rallied a lot. It's had a little correction the last couple of days. It's still at around 3,200. The 10-year US Treasury yield has rallied. The yields have spiked a lot in the last couple of weeks. It got up to like 4.4 something. It's down to 4.36, still substantially higher than I think what Trump and Vicente had planned. I want to ask you, Peter, about the volatility in the stock market and the bond market in your career, many different cycles, bull markets, bear markets. Have you ever seen anything like this type of volatility in stocks and bonds at the same time?
Nothing close to it. If you think about it, last week we saw something that I don't remember ever seeing. If it happened, either maybe my memory doesn't remember it or what have you, but we had a big down day, and I mean big, in stocks, in bonds, and the dollar, while gold was up a lot. And I don't remember anything like that, because normally what happened if the stocks were hit for some crisis, bond people ran to treasuries, or at least the dollar would go up, and none of that happened. And at the same time, gold was purchased quite heavily. And the other thing that, and keep in mind, it's a little bit different when you're looking at something that's 40,000 versus when I first started, the Dow was, 1,200, 1,800. Still seeing 500 or 1,000 Dow points change in 5 minutes or less. It's just, it's beyond reason for what, when I first entered the business almost 42 years ago, the stock market long ago stopped being what it was originally set up for, a place to buy and sell part ownerships of businesses. It's become an extremely large tech-based casino-like atmosphere. And the bigger you are, the more chance you have of success. It's very, if I may, I know I'm going to go off a little here, but let me just say this. 98% of the people trading don't know what I'm about to tell them. But Bloomberg a few weeks ago came out with a study and showed for the first time ever, more trading was taking place in what they call black pools. These are where the big financial institutions trade away from an exchange and just trade among themselves. So when I hear these people tell me they're sitting home all day and trading and watching CNBC or whatever the case may be. And I tell them, you're not seeing a lot of the actual activity to make your judgments on. It's just it's 180 degrees different than it was when I first joined.
Oh yeah, I totally agree about your point about the casino. And then you add in what high frequency trading algorithms, and these things are responding to whether it's like a Trump post on Truth Social or social media. He used to be on Twitter, but now he has his own social media platform and a publicly traded company there with his the SPAC one that's social media oriented. So the market is just reacting to press releases almost like every minute or two. It was just wild with the swings.
So the other thing that's important that you brought out, and it should be discussed, when I started in 1984, 87% of the trading on the only two exchanges that existed at the time, the New York Stock Exchange and the Amex, was done by retail, and only 13% was institutional. Last year, well over 50% of the money that's in the stock market is in passive funds. These are funds that are tracking an index or an indice by a manager who's not actively trading, meaning he or she are not making individual decisions, well, I'll buy this one or sell that one, but they're just responsible to mirror the index or indice that fund is trying to track. And therefore, it also played in the role in the narrowness because only a certain amount of stocks made up those indexes, like the S&P 500. So you would look at a company like Apple, which was basically in almost all those funds. So as money kept coming into the stock market, those managers couldn't even say, you know what, I want to hold some cash back or I want to look elsewhere or maybe go overseas. No, they had to go out and buy Apple and the other ones that made it up. And that was all good when the market was going up. But what you saw in the last 2 weeks is you saw the opposite of that when the passive funds managers got sell orders. They couldn't hold back. They couldn't say, no, I don't want to sell this. I'm going to ride this out. Now you have that. And then the remaining about half of the money, two-thirds of that at least is in what you brought out as computer algorithm trading. It could be as simple as just trading off a headline news to some very sophisticated trading programs. The smallest percentage now of money that's in the market is what the market was originally set up to be. People buying and selling individual part ownerships of businesses. That's why anybody that tries to tell me that they're trading with rules and ways of looking at markets, whether technically or fundamentally from 30 or 40 years ago, they're playing with pea shooters and they're going up against people that have nuclear weapons.
And long-term investors, the definition seems to have changed too. I mean, a long-term investor, when I started in 2007, 2008, I was reading Warren Buffett books, value investing stuff first. And I was getting training on that, how to look at the balance sheets, financial statements, those types of things. That seems to have died. And people's definition of what of a long-term investment is a couple months, maybe a year tops. People aren't even thinking a couple years out, like long-term, long-term.
So when I started, the average report had a 3 to 5 year outlook. That was the typical. Now nothing really goes past the next year, and some are even shorter. And unfortunately, uh, the corporations began to think that way and made decisions that might have not helped longer term, but maybe enhanced shorter term because also the compensation to the people up at the top was so much based on the stock performance and all. So I'll just end that part of it by saying the market that we knew in the 80s and even into the 90s is is a mere shell of what it's really become.
Yeah, I totally agree. I mean, and you add in the derivatives, the leverage, the bailouts, there's just moral hazard from these hedge funds, private equity, large corporations. They think that they can hire lobbyists and get a bailout. And then these large Wall Street investment banks post 2008. I mean, I think, Peter, personally, that the system morphed into a Ponzi scheme with all the leverage in the system. And a lot of these large hedge funds or portfolio managers of banks think that if they have an over leveraged bond trade or something like that, they think that they can get a bailout.
Well, there's also another key factor, and uh, some people get upset when I say this because they're of their youth, but well, 40 something percent, I think it's 45 or 46 or almost 50% of licensed financial advisors in the United States today weren't even born when I started in 1984. And the majority of them only been in since the year 2000. And the reason I bring that up is, well, A, you don't get a discount if you use inexperience or somebody with lesser experience. And that doesn't mean that they can't be smart or everybody that has experience is very smart. But one of the things that has happened with that is they basically learned to drive on a one-way street. There hasn't been any length of period of time where the markets didn't recover right away, even if there was a large downdraft or major fall, and people were always willing to do something. There's going to come a point, and I think we've entered that. That's why I've taken the positions that I've had, and although the market may not go down a lot, the above average returns that people got used to, especially from the financial advisor side, I don't think is going to come. And that alone is going to cause an issue because still 7 or 8 out of 10 families that I see for our planning group here in the States are living at least one or two lifestyles above what their finances truly support. And one of the things they've grown accustomed to is the above average returns that the markets have offered. And so when that peters out, and I think it is, even if we don't go down, the fact that we just don't have the gains, it's going to be a real negative, and that doesn't take into account, the bigger picture of where I think, and what I started the year off not wanting to have any exposure in U.S. equities and would only look at other places overseas because of this continuing de-dollarization and movement away from the U.S. And I don't want to get ahead in the conversation, but what Trump has done has actually accelerated that, in my opinion, and that the BRICs, which I've been a huge believer in and was in a small minority, I think they just had their best last couple of weeks in terms of getting new members.
And to add to your points there, the Alan Greenspan Fed, then the Ben Bernanke Fed that followed that, and the Janet Yellen Fed, I think they all focused on asset price inflation because what they kept interest rates artificially low. They did bailouts. They allowed Congress to run a base case $1 trillion budget deficit or larger in some cases, depending upon what type of bailouts or what asset class had a problem or what industry needed extra capital or emergency liquidity injections or whatever they called it. And it just seemed that that was intentional policy to juice what the S&P 500, the NASDAQ 100, and home prices for the last couple decades up until recently.
Yeah, and then we had the COVID where we added $7 billion dollars in new printed money. Uh,
Oh, you mean trillion?
Trillion, I'm
See,
sorry.
we're on to trillions now.
Yeah, sorry. That's a number that when I started, we had no comprehension of. We didn't think of or even talk about anything in the trillion. We never imagined it. In fact, I can remember when our long-term debt hit a trillion, and people start to say, how's that going to be? How are we going to? Well, it's 36 of those heading to 40 very quickly. So there are a whole host of things now that make hard, if not impossible, for me to have any real bullishness towards U.S. based equities, even the bond market, which still is the lesser of two evils. But again, that's a separation because I think on the corporate side, and we saw this last week, we saw a tremendous spike in those yields because the concern is finally hitting home that some of these companies are going to have a big difficulty refinancing, especially when something like, I don't know, 35 or 40% of our total US debt has to be refinanced in the next few years. So there could be some serious troubles in the credit market on top of the things that are happening in the stock market.
And I actually wanted to ask you more about the bond market because normally in past cycles, when the stock market has a very large correction or crash and goes into a bear market, normally that benefits what the US Treasury market. For listeners out there, the yields start going down, capital starts to flow from stocks into US Treasury bonds, normally what longer duration bonds, 10-year, 20-year, 30-year US Treasuries for safety. And we did not see that happen. It seems there's been a lot of public statements by both President Trump and his Treasury Secretary. The Treasury Secretary, the new one, Scott Bessent, he's a former macro hedge fund manager like you, Peter, and he's done interviews like really in-depth podcast interviews talking about like what the whole plan was to refinance the U.S. debt, and yield seems to spike. Do you think that things have backfired with the policies that they put in place, and this is not what Trump and Bessent had planned with the bond yields?
I agree with that. I've been in from the early days of this, especially in the swings that we saw last week and even this weekend when it came out on Saturday and everybody, wow, look at this news. He's backing down. We're not going to charge semiconductors and all. And then that's because Ludnick says something. And then the president puts out something that's different. And then a third party puts something out in the middle. I also think this. I think that he thought everybody was going to just bow the moment he did this, that just across the board, people were going to, come and just cave. And while you can say about 50 countries and all that, the key countries are your top two, three, four. China is clearly not. Canada, which everybody has lost sight on, that we're still the two biggest trading partners. The view of Canadians now versus America in this last 90 days has just changed dramatically. And now we saw this, and I think this is, really critical news that China, Japan, and South Korea are going to form their own alliance. And that comes out of this. This is being born out of this situation that the United States has taken upon itself. And I think it's kind of like a bully move that the bully thought he can go and just push a few people around and everybody would fall into place. And I think the opposite has happened. And I'm not an anti-Trumpster. I don't have the orange syndrome or anything of that nature and all. I'm just seeing it the way it is. And I think and there'll still be somebody saying, "Oh, this is the art of deal. This is how he works." No, this is really regressed on him. This is not this. They have an uphill battle now versus what in the early hours of this movement, everybody thought it was just a slam dunk.
Yeah, I totally agree. I think things have backfired. I think they definitely wanted the 10-year or longer duration treasury bond yields to go down. Now, I've heard rumors that they're trying to do this and negotiate behind the scenes to get those trade deals done where the trading partners as part of the trade deal start buying longer duration bonds. It's just a rumor now. I haven't seen any concrete announcement about any of this, but the bond market is definitely calling the bluff here, and the capital flows, Peter, with the sell-off in stocks, the bond yield spiking, the dollar getting weak, the gold price going up. It looks like for capital flows, instead of the normal safe haven for treasury bonds, a lot of foreign traders, whether the non-G7 central banks or institutional investor, foreign pension funds, they've decided that they're not going to buy as much U.S. stocks, U.S. treasuries, and hold dollars. It looks like those capital flows are going out of the U.S., leaving the U.S., and Trump thought that they would stay in the U.S., and instead they're going into gold or emerging markets, like you said.
Well, really into gold. That's really what replaced when you saw that last week when those three markets were getting absolutely crushed and gold's trading up $100. And then not back off from that the following day when the stock market recovers, that was an indication that serious money went into the physical market. And of course, the paper market that used to kill any momentum that could be gained out of the physical has been basically put into a terminally ill condition. China and what's happening in China and their physical demand, even in recent weeks and news, again, that you don't hear on the mainstream financial, but it was very critical news that China had authorized their insurance companies to start being able to buy physical bullion. This is all a change that we saw. This is a change and why I got so involved and bullish on gold a few years ago when I saw the movement away from the states, the de-dollarization, and that those countries were gonna, and they were openly speaking about using gold in some form to do their trading, whether it be just on a regional basis or a whole new currency some way down the road or whatever. And all their banks were buying it. And we were seeing 33 banks, central banks repatriating their money from the US and London. All those things was a major change and reasons why I took such a bullish stance on gold. And while gold is no longer cheap relative to where it's just been, there's no sign that that movement has lost strength. In fact, I think it's going to get a second wind because of how the backfiring of this trade policy that the United States tried to implement.
Isn't there also a change in the bank reserve laws, what for Basel III, where now I think gold's a tier one reserve asset, so that's starting to go into effect too. So that's giving the banks, these large commercial banks, more of an incentive to hold physical gold as a tier one reserve asset.
Oh, no question about that. And the other thing that I think, and I think this was part of their plan, and that's why they brought up that Fort Knox stuff out of the blue, is I think there's some intention to use gold to back bonds because they know that it's just going to be tougher to get money in the world now than it used to be for the United States. You know, people talk about the dollar, and the dollar normally would have been rallying in this, and it's really backed up here. It was just a couple months ago that people were talking about the euro going to parity, and here it's trading, at 113, 114, somewhere in that area. And these are the type of things that happen because the usage of the dollar on the world stage is becoming less and less. And what everybody forgets about that is this: those dollars still exist out there. And if less countries are using it, eventually they're going to come back here. That's inflationary too. And it's just, there is no avenue that I see that we can escape unscathed. Now, Americans like to do that. And that's the problem also, by the way, Jason, Trump has. He has much shorter period now. You're already seeing some on the fringe of people that were openly supporting him just taking a little step back now and all. And if this doesn't turn around or we get another wave down in the stock market, that becomes really interesting. And one thing the Secretary Treasurer put out that I thought was phenomenal news, and I think we all need to take it into our consideration if we're going to be anything involved in markets. He brought out a very interesting statistic, which was backed up and shown to be true. He said that the top 10% wealthiest people in America own 86% of all the assets. The next 40% own the remaining 14%, and the remaining 50% own nothing. They're indebted. And so if and when the markets get tougher, yields go up, credit becomes tougher, the stock market goes down. As much as we think the local person, the 401k is getting hurt, the real wealthy and the real movers and shakers, they're going to start to see some substantial losses. Now, what's been real interesting in the last couple of weeks, and again, this is only because I follow certain people that have knowledge on this. It's not an area of expertise, but we've seen a great shift even by the hedge funds out of U.S. securities and also foreigners liquidating U.S. securities. And the only net buyers in these last several weeks were U.S. retail investors. And I'm sorry, but those tend to be the people at the last part of a move in the equity market, not the beginning.
And I think Trump inherited a large mess, him and his Treasury Secretary, because Janet Yellen, I mean, she did not refinance the debt. She had the opportunity at lower interest rates to refinance the debt. She chose not to. The budget deficits blew out. They were way over $1 trillion. I think the final number is almost $3 trillion here from 2024. Some of the numbers are just staggering, the size of the budget deficits as Biden was leaving the White House. But it's really both political parties, because the base case was $1 trillion budget deficits post 2008 every single year. That was the base case. Now you add in what, $1 trillion of interest payments on the national debt. That's like added on top of everything. That's like an enormous credit card payment or a balloon mortgage payment. And the numbers just become untenable at some point, with even with what record tax receipts we're at. The government's claiming they have what, a tax receipt problem. We have a record tax receipt. It's almost $5 trillion the government's bringing in tax receipts. It's a spending problem, not a tax receipt problem.
Well, I think historians 25, 50, or 100 years from now, when they look back and they talk about how did this country get to where it's gotten such bad, there won't be a name that will be higher on the list that helped to cause singly more of that problem than Janet Yellen. Between her time at the Fed and as Secretary Treasurer, I don't know of anybody that's done more to damage or not do the right things while they were in the position. That's why I saw her last comments the last few days. I wanted to just put up a post and just say, shut the heck up, because she's done nothing. Like you said, at the time when we should have just taken every short-term debt and refloated and put it out 30 years when it was 1 or 2%, she did the opposite. And she's again, and that's another thing I think that's important to make, Jason. I know we're all over here, but I think it's important. This Fed chairman is no friend to the president. I mean, compared to who's ever else been president and whoever was the Fed chairman, I think there's more dislike between these two than any others in the modern time. And I don't think he's going to be as quick to be a savior as otherwise might have been. And so I think anybody that thinks the Fed is just going to go into some mechanism again and be the Fed put and save everything, I don't think that's coming.
Yeah, I agree. I think Powell and Trump do not get along. I think there's a lot of evidence of this, that Trump tried to fire him in the first term, so they definitely do not get along.
Yeah, and I also say that the Federal Reserve doesn't have the influence on the markets here and abroad that it once did as well. And I think people lose sight of that sometimes.
So I want to ask you about institutional ownership of gold and gold stocks. So a lot of these generalist fund managers, for our listeners out there, these are like pension funds. These are generalist institutional investors that have 50 billion or more assets under management. In the past, Peter, I don't think they had any gold or gold stock exposure. Do you think we're starting to see now, with the gold price and the gold stocks, that these generalist fund managers and pension funds, they're going to go from 0% gold exposure up to 1 or 2% soon?
So the number that's tossed around, and I don't know statistically how accurate it is, but they say that the average exposure to gold in the typical portfolio in the United States is between 0.5% to 1%. Some people say as high as 2. I don't think it's even close to that. The question I propose to people now is, do you know that since the year 2000 or this millennium, where the bulk of financial advisors have only been practicing, that investment has greatly outperformed both stocks and bonds? And my line always is, how come you don't own any? That's the question. How come you're a financial advisor? Well, we know because they treat it like kryptonite. I think the issue is retail will be the last. In fact, when you are just talking in an average place, or you're in a store and people talking about gold, we should be thinking about going to the exit. I think what will transpire, and we're seeing it, and I think this is how it's going to play out. I'm not certain, but this is what I'm speculating on. So we're going to see earnings basically flat to down in most industries for this year. No question about it. How does anybody even plan at this point in time with all the stuff that's happening with tariffs and dramatic slowdowns? We just saw the second lowest number ever on the consumer sentiment. So we're going to see lower earnings across the board. But those generalist managers are going to look and go, hey, Johnny, look at this gold performance. These guys are knocking it out the park. They're up 100, 200% on their earnings, and because they're printing money. It's $3,200 gold, maybe well under 2,000 net cost. And then their two biggest things that are normally the most expensive to a gold producer, energy, oil, and labor, going to go down in cost. So they're going to attract the generalist who needs to show performance. That's the good news for the way the markets come on short-term performance needs. The people go there, they're sheep. Once that starts, they'll all go there. Now, I know it's starting because in the last few weeks, from people that ended up, I guess, doing a search on my name or something, or I appeared in an article somewheres. Oh my God, Pete, I didn't know you were back in the gold. I haven't looked at gold in years. What do you think? What do you like? So I think that's just beginning. It'll take longer to get down to the lower end of the food chain, the juniors and all. But I do think we've already seen it beginning on the gold end. And what's real interesting for me is I think the spread has become so big between the gold and silver price, because I was never a silver bull. I say this all the time and it always got me in trouble. I used to say silver's like kissing your sister compared to owning gold. But now, because of the dramatic in price in gold and the spread at just basically almost historical ratio levels, I think it can more than keep its own here and maybe even eventually start to outperform it later in the year. So I think both gold and silver will be in traction. But I think the other one that is going to bring people in, because it just continues to show this relative strength that most people assume by now it would be a lot lower, and that's copper. So I think metals in general, the primary metals that we think of, gold, silver, and copper, I think they still have lots of upside and growing interest before any even major intermediate correction will come about.
And the gold miners have only started to rally really in the last month or so. They were drastically underperforming the metals price. To add to your points there, Peter, I think really over the last 3 years, and I know that central banks were dollar cost averaging gold tonnage every month, so steadily. There was a steady purchase of it. But I really think over the last 3 years now, we're 3 full years post Russia sanctions, early 2022. So 3 full years now here in April 2025. I think that caused a huge paradigm shift. And then on top, so basically the amount of monthly dollar cost purchases by non-G7 central banks that about doubled post Russia sanctions in hindsight. So those are the numbers. That's a higher plateau of monthly gold purchases. You add in the Asian retail demand with weaker Asian currencies up until recently with the rally in some of these Asian currencies against the dollar, but Asian currencies were weak for a while. So that was causing a huge demand increase in Asian retail demand. And now you add in what the institutional investors that are starting to come in, and then these Trump tariffs. Peter, if I'm a foreign country and Trump is just putting out basically a fake formula for a high tariff. And I'm scratching my head. How do we even figure out this formula? How do we even negotiate with him? Because he admitted, or him or his trade people admitted in public, that the high tariff number, the formula is fake. They just wanted to bring us to the negotiating table to scare us. I'm thinking, why should I buy treasuries? This is a headache. Why don't I just go buy more gold?
Well, that's my whole argument. I think this will end up doing more to move the continuing away from the United States, not back to it and all. And listen, there's a hardcore group. I'm married to one that's this Magna type of, Trump can do no wrong and he's the greatest answer to this and all. I don't fall in that camp, but I'm also not an anti or hate him if he talks or breathes. I think some of the things he's done is good, but I do think this decision that they made will come back to
Well,
really bite them, and it's starting already. Listen, they will cave and try to still make it look like they gained, but I think people that are very smart will see through that, and I'll be proven correct if and when the BRIC meetings take place this fall, and they're talking about 40, 50, maybe even 60 new members, then correctly. But I want to go back and just say it. This news of South Korea, Japan, and China forming their own separate alliance comes clearly because of what's happened here. And that's a big negative for the United States.
Well, I also think the tariff policy and the trade policy will create a lot of distortions and confusion. So you will see private sector investment and capital come back to the US. So that will be investment by these companies with factories, Nvidia, the car companies building factories here. However, I don't think it's as easy as Trump thinks, where like they're also going to buy treasury bonds. They're also going to reinvest all this capital into other asset classes and all these other things. I think they'll invest wherever there's what the Trump tax cuts. So if there's corporate tax cuts here or trade exemptions where there's no tariffs, they'll invest in those things. But there's nothing to say that they don't have to build a factory, and it's mostly what these humanoid robots, and there's hardly going to be any humans, because that same factory, Peter, will still, that'll be capital investment, and it will pay taxes to the US government and the other levels, but it just won't employ as many human workers then.
Jason, I think it'd be a long time for such an event to happen, even if it was to happen at the fullness of what Trump would like you to believe in terms of so much coming back here and planning. There's a huge problem. Listen, there's a significant reason why it left here. Okay. One of the main reasons it left here is because corporate America, run by publicly held companies with CEOs paying themselves 10, 20, $50 million a year and upper management making all sorts of money, went over there because they knew they could make more money by doing it over there. And they're in no hurry or desire to bring it back here, because when you bring it back here, you run into some issues. Obviously, one of the biggest issues, if you're not in business, you don't know it. I deal with a lot of business owners, is regulatory and legal issues, the cost and the time that businesses have to be consumed due to that, not just on federal levels, but state and local levels. But there's another missing quality that no one, I shouldn't say that. There are people speaking about it. They're just not on the CNBCs and all. And that is, do we have the level of workers to be able to perform those services that people got? It's one thing to say, yeah, they're going to stand there and tie the rubber band. But if we're going to go back to strong manufacturing, listen, did we not learn a lesson in COVID when we woke up one day and found out all the key things we need, from pharmaceutical to strategic metals and all, aren't here? And not only are they not here, but where they're being made is from people who are not allies and could be one day, before we even know it, at war with us. So this is not something that quickly turns. And here's the other thought. What happens if there's enough political lost will that it doesn't go as planned? And before you know it, in the midterms, which are now, 18, whatever months away and all, he loses influence in one of the houses. The Democrats take back the House, or something. This, I really just think this scenario went in with guns blazing, and when they looked around, a lot of shots were fired, but no real enemy declined or hit the ground.
Well, and some of the policies have backfired too with the bond yields, because I think the whole goal was to listening to stuff from Scott Bessent and Trump, and what they basically had discussed this before he even had his inauguration. They wanted to get that 9.5 trillion or so of US Treasury debt that's expiring in the next 12 months or so, refinanced at lower interest rates, I don't think they're going to be able to do that.
Well, like I said, there's a lot of things afoot, and most of them I don't think are bullish for the long term outlook for America.
Yeah, I agree. And I think it'll be weaker dollar. I think it'll be more problems. I think like best case scenario for the US is probably more stagflation though, unfortunately. So I see either a weaker dollar, higher costs in the supply chain for small business owners. I see stagflation and shrinkflation for most people.
Okay, it's not a pretty picture.
Well, now I want to transition to gold stocks, Peter. Now you've been covering gold stocks for a very long time. Are these the best profit margins, free cash flow you've seen out of the producers and the royalty companies in your career?
Well, they've never been in better shape, the producers. Normally, they would get into indebtedness. Uh, the 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 tremendous increase in the gold price in the time frame that it has done, without these guys getting too crazy, uh, they're not boosting up. They're not going out and borrowing a lot of debt. They're not making all sorts of acquisitions all over the place. This is probably the one of the best, probably the best time for a producer that I've seen. And of course, the royalty companies, because of the tremendous in price in the gold, they they're doing real well. But what I think is going to be even more attractive, and probably why the barracks and all keep talking and moving towards this, is that projects that have copper and gold in them, because copper is such an intensive, uh, high cost usually to bring out of the ground. Yet with gold as part of the project and such a high price, you can get in at a much lesser cost and then get the copper, and hopefully copper will still be $4 or $5 or even $6 a pound. So this is certainly the best shape the majors have been in since I've been in the business.
Did Trump say he's going to put a tariff on foreign imported copper? Because I know he's doing one on aluminum and foreign steel. Did he say he's doing that on copper? So that's going to benefit what U.S. copper producers then?
Well, there's been talk about it. The bigger news for copper still. Well, first of all, the first thing that ran it a few weeks ago, everybody thought there was going to be tariffs and we weren't going to be able to get any. And then when they realized there wasn't, they dumped back. But what's what's coming out now is that the concentrate, or the people that actually turn it and refine it, which mostly in Asia and particularly China, have a shortage, and that's what's boosting the price right now. What you got to remember also is, if the don't worry, be happy crowd is even half right about their predictions of AI and electrification and all of that, we have, even Trump said it last week, we don't have the grid and the system set up to supply that. So not only is a lot of money going to have to be spent upgrading the ability of how to deliver electricity, but we're also going to need the raw metals that go into that. And of course, copper is the single best when it comes to electrical. So I just think that if you're a major out there and you've seen what's happened in the world now, you don't just spin a globe, let your finger land anywhere and say, yeah, we're going to go mine there. It's become very selective. And some of the places in the world that people might have used to run to, look what's happening in the Congo right now as we speak. Look what's happening in West Africa with nationalization of mines. West Africa 30 years ago was an extremely popular place, especially in the junior market and all. Look what's happened in Panama and some other South American countries of nationalization and social and political unrest. Majors aren't about to go out and spend multi-billions of dollars, which basically that's what's going to cost for a big copper project, unless they have two things or three things going for them: safety of political and social issues, uh, hopefully lower costs, not where they got to strip, and they're only getting half of 1% copper in it, and also that they have uh, safety for their own people. And that narrows it down. That's why for me, outside of one issue, I stayed in North America. Listen, there's places in North America, you're not going to get a mine built in California right now. But overall, I think the majors are much better negotiating. I don't think they're just going to go out and spend all sorts of money. I think one of the things that's going to kick off here, we're going to see a lot of strategic placements. They're going to look at the one or two out of 10 juniors that look like they can go all 9 yards and start to finance them so they could, basically hopefully assume that in a few years' time, they could take whatever they come out of the ground with.
Yeah, I think Agnico Eagle just announced one of those. You mean a private placement, right? Where they buy like they
Yeah,
finance a drill
yeah,
program and buy like what, I don't know, 20-30% of the equity of a
yeah,
junior.
yeah. You'll do that. I don't think that the Agno Eagles and the top 5 or 7 are going to suddenly upgrade their own exploration programs. I think it's too cheap out there. There's too many projects that it's because the juniors have so underperformed, and even the small developing mines so underpriced that why should you go spend $150 to $200 an ounce by the time it's all said and done from starting to the end, and the ones that fail, when you can get ready-made projects that are being priced as still as low as 20 and no more than $50 or $60 an ounce in the ground. So that's where I think you're going to see the majors heading.
Yeah, I'm looking up the VanEck Junior Gold Miners ETF GDXJ. It's up 48% in the last year. Really, in the last 6 months, it started to move substantially from the bottom, but all-time high, I mean, it's still down, I think, 40% from the all-time high back in 2011. I think it was up at just under $160 a share, so it's at 62. The GDX is still substantially, which is a larger gold miners ETF, that's substantially below the all-time high in 2011. I think it was around 65 a share, and it's at 50 right now. So we are having a perk up now. I think capital that initially went into what, just gold related stuff, physical gold, maybe some of the gold futures contracts, physical gold trusts. Now that these gold miners, Peter, have what, at least the last like 6 months or so of good profit margins, people are starting to notice, like you said earlier in the interview.
And gold is up $1,200 from 2011 as well. It barely touched 2000 back then. Now it's 3,200. So the opportunities for those companies to make even more money, that's what makes those GDX and GDXJ even cheaper.
Well, also you have the investors business daily crowd, right? So if the gold miners are the only ones growing free cash flow, the ones that have the positive fundamental growth, right? That people are tracking like revenue growth, free cash flow growth, profit margins growth. That's the type of stuff that investors business daily kind of tracks. And the gold miners are actually getting high scores with free cash flow growth and those types of fundamental improvements. And the other industries are not. I mean, the capital flows are going to start moving into the gold mining sector then.
Yeah, no question about it.
So for juniors, you said that people should be careful about geopolitical risk because what governments now at the high gold price are going to start wanting to increase royalty taxes or seize mines. Do you think that that's one of the major risks out there?
Well, I think it is in more of the outside of North America. The one thing I'm also hearing is particularly out of Canadians, companies, especially those that have advanced stage exploration and have already started to do, preliminary economic assessments and all. They've said they never seen where the government is so much on their side now that they realize that the regulatory and all the issues to get these things out of the ground, making it 3 or 4 times longer than it may have been in a third world country. Governments are now fully supporting them, both, local, providential, as well as federal. And the same thing here in the US. So that's a real big plus because those were the things that always used to cause hiccups and end up have to be considering and why people didn't pay up because they said that this thing could take a lot longer than expected.
Last question here. I want to ask you about Argentina. Do you think that Argentina now with Milei in power, some of the tax laws he put in place, I think there's a huge tax break if a mining company invests $500 million dollars or more in the next, I think by end of 2026. Do you think that Argentina is going to be experiencing a mining renaissance over the next couple of years?
I'm sure some people will, but for me, and I think a lot of other people, we really have narrowed our focus. And again, like I said, I don't want to go south of Miami. So the bottom line is I will stick with North America. I mean, there are a handful of companies. I have an investment and a company I like very much in Ireland. I don't see Ireland nationalizing projects at the moment. But there too, there are some social issues you can be concerned about. So all in all, I just think some of this the stalwarts that always have been good. We know places like in Canada, Quebec is so mining friendly. There's a few other provinces. We know states like Arizona and Nevada and Idaho are very favorable towards mining and all. That's where I want to keep my focus.
Now the gold price has moved a lot over the last like 6 to 9 months, a lot more than I expected. I was saying 10 months ago that I thought that 3,500 gold in 18 months or less would be reasonable, that there was pretty good odds of it. Now I'm probably going to have to start revising my price target higher. I know we're starting to see that with the Wall Street investment banks like Goldman Sachs and the others. Do you think we have a pretty high probability that we see $4,000 an ounce gold or higher in the next couple of years, just based on the fact that these other countries and like institutional investors are going to be allocating away from what U.S. stocks and bonds and into what more gold as a reserve asset with the commercial banks and for the central banks for their foreign exchange reserves and trade surpluses instead of the normal reinvestments into treasuries?
I think there's a $300 to $500 move that can happen just in a matter of weeks, but I don't know whether it's up or down, and I don't know if it's now or 3 months from now. Listen, it's very extended, but there are life-changing things that are happening that have driven the price here. But when you've not really had any lengthy consolidation or correction, and you've moved this much in a market that normally doesn't move that way. But I like to close with this and remind people that are listening that when I entered the business in 1984, uh, the Dow had traded for almost 11 to 12 years between 700 and 1,000. And in the early 80s, there was such fears that even a Business Week front page magazine made news by saying equities were dead. Inflation was double digit, interest rates had been at 20%. People couldn't imagine the stock market going up a lot. And then a guy came out of Gainesville, Georgia, that no one ever heard of, and certainly didn't ever hear of his technical analysis called the Elliott wave theory. But Robert Prechter Jr. came out and said the Dow's going to 3,600. And I remember people, experts on television, all going, "What's this guy smoking? 30, it can't even get much above 1,000." And not only did it go to 3,600, it went 10 times more than that. So you can't say that gold can't go to certain levels. You just know that after the move that it's had, you always feel a little bit better to see some consolidation and corrective. What I do think, and what I've changed for myself, is I think the leverage now will come in the shares. So if gold does have another 20% up from here, the shares could double, and some maybe even triple because of that. And therefore, I'm more interested in the shares than the physical bullion. But if you bought physical bullion for more than just capital appreciation, and you bought it out of monetary fears or the world can collapse and all, there's no reason to run and sell it. But I will say this: most people that bought physical bullion, including clients of ours as low as 1,300 and still own it, never really acquired any silver during that. So rather than put new money, additional new money in, maybe those that are in that type of situation want to take a little out of gold and own some silver here, because the ratio has gotten to an extreme. Not that there's any set rule that a ratio must trade between a certain level and never go past this, but historically it's quite favorable now to start to look at silver here. And maybe that's something that someone would want to do that owns a lot of gold, and that is to take a little off and put it into silver.
I'm not really worried about the gold market if the gold price has a correction. I'm more worried about what's going on in the treasury market, because normally treasuries would be a safe haven for all the volatility in stocks and the correction in stocks. And it looks like there's a huge bear market, a long-term bear market in US Treasury bonds, and yet the government needs to refinance more, just trillions of dollars at higher interest rates. It looks like they're going to have to enact what Luke Roman and some of these other macro experts are warning about, what yield curve control. And then we're going to have similar bond market action to the 70s and 80s, where there was a long-term treasury bond bear market. And then they were called what, certificates of confiscation, or kind of the war bonds during World War II or something like that, where the government's intentionally devaluing the debt. It's going to look like that.
Those are all possibilities.
Yeah, it's just ugly. I mean, the math just doesn't work at this point, Peter, with the interest payments on the debt. I mean, I do not think Trump and Besant were planning this now, especially if the 10 years treasuries don't start going back down soon.
I concur with you.
Well, thank you so much for your time. It's very interesting times. It's in a lot of aspects, it's looking like kind of the 70s and 80s or post World War II here with yield curve control. But then you add in all the trade war and stuff from the 20s and 30s, and it's just a mess. And I could see why a lot of people that normally wouldn't buy gold are now buying gold because you add in all these things. It's like, oh my God, I have a migraine just even thinking about this stuff now.
Just remember this, Jason. I'll definitely close with this. When we say it could be like the 70s, 80s, but at least in the 70s and the 80s, we weren't indebted to the level that we're at. We have far fewer cards that we can play now as a country because of the way we've lived the last 30 or 40 years as a nation. And that's the big issue. 65% of Americans are working paycheck to paycheck. Not only do they not have any room, look at here in New Jersey, they're just about to raise electricity on average 20%. Your bill is going up. To some people, that's going to be the difference of whether they can turn their air conditioner on or not. So there's a lot tougher times ahead because things that were more readily available and more room we had to spare no longer exist. And that's the big issue that most of the don't worry, be happy crowd on Wall Street, even if they know it, don't want to talk about it because it would be the reality. And I think the average person would have a much more bearish or more cautious stance than they've taken.